this one, and then who knows what comes next.
AA+ credit.
Was that sinister enough for you,
That was
Bramo?
good, yeah, I like
I'll
that.
take the hate mail on the weekend.
Yeah,
Do you want me to be the bear of the week? I can be the bear
I
of the
don't
week.
mind the hate me ML. I think it's instructive. I think it's good.
From New York. Futures down 2/10. We don't do hate mail. It's unwelcome and unnecessary. Just send it all to Tom.
They
This
send
is
it all to
Bloomberg.
me. You got that right.
With the First Word News, I'm Ritika Gupta. Shares of HSBC are rising. Second quarter earnings were better than expected, and the bank promised to resume its quarterly dividends next year. HSBC is pushing back against a call by its largest shareholder, China's Ping An Insurance, to split up. The architect of the Democrats' tax, climate and drugs bill, Senator Joe Manchin, is lobbying colleague Kristen Sinema to get on board. Manchin argues that the measure does not raise taxes. Sinema has not divulged whether she will support the bill or not. She has the power to sink it. Minneapolis Fed President Neil Kashkari says the central bank is committed to slowing inflation to 2%. Kashkari told CBS the Fed will do what's necessary to bring down demand. He said faster inflation is being driven by supply chains disrupted by the war in Ukraine and other factors. Boeing is starting the week with a double dose of good news. For a few days at least, the aerospace company has averted a strike by machinists that would have crippled its fighter jet factories. Meanwhile, regulators have okayed Boeing's plan for repairing tiny flaws in the 787. That is a big step towards resuming deliveries that have been largely halted since 2020. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
A live
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Right now, markets believe the ends to what the Fed wants, lower inflation. They don't quite have it right about what the means will be. The means will be tighter financial conditions. In our forecast, we think the Fed declares victory a little earlier. Remember, Paul Volcker did too.
That was the brilliant Vincent Reinhart, the chief economist at Dreyfus and Mellon. He's not alone. This from Bill Dudley, the former New York Fed president. Earlier this morning on Bloomberg Opinion, he said this wishful thinking is both unfounded and counterproductive. Live from New York City this morning, good morning with Tom Keene and Lisa Abramovich. I'm Jonathan Ferro. Kicking off a brand new trading week, a brand new trading month with futures down 1/3% on the S&P. TK, the NASDAQ 100, a little softer, down 0.2%.
A little softer. It'll be interesting to see what Apple does. John's surveillance correction. Bob emailing in from the Hamilton College goalie camp. Thanks for listening up there near Lake Moraine. And he says, Moody's has Apple as AAA. You were correct, John. And I was also correct. S&P has it at AA+.
There we go.
I don't know what the difference is, but, you know, we like to have a surveillance correction when we need one.
Who are the other two companies, Tom? I believe it's Microsoft and J&J, isn't it? I think. I will double check. I can see Lisa typing away at the corner of my eye, so I know Lisa's double checking right now.
Fired up.
It's taking a minute to load. Yep, J&J and Microsoft.
There we go.
Good job.
Thank you.
And she knew how to find it.
I can take the week off. I'm pleased we paused for that.
You got any more data here before we get to
I'm so done. I'm so done.
Very good. Well, welcome on a Monday. It's a No News Monday. We're kidding. 10 o'clock this morning, that first look at the American economy with what John loves, the ISM. And then a lot of data coming up, crescendoing to August 10, when there is inflation. Win Thin joins us now. Global head of currency strategy at Brown Brothers Harriman. When finally a dollar breather, is that it for strong dollar?
No. And a simple, quick answer is no. Look, I know the dollar bears will come scurrying out. They've been very quiet the last few months. You know, to me, it's a lot about positioning. It's really mostly about the yen, if you think about it. The euro's having trouble getting much ground because basically the Eurozone is heading into recession much sooner than the U.S. Will. Germany's already there. The other major economies are heading there. So to me, as an FX analyst, you know, you always have to ask yourself, you know, you're bearish on the dollar. What's the other side of the coin? And to me, the other side of the coin looks very ugly. Eurozone, UK, China, Japan, you know, all grappling with the very same issues that the U.S. I just happen to think the U.S. economy is much more resilient than these other economies are right now. And so I remain dollar bullish. But we've got a period of consolidation, no doubt about it. As you pointed out earlier, we've got some key data that'll set the tone, you know, for the sort of medium-term dollar outlook.
When I want to talk about China, John and Lisa have mentioned the domestic disquiet in China right now. How does it redound to the Pacific Rim? How does Brown Brothers Harriman play the Pacific Rim currencies?
Well, the China situation is so complicated. Before sort of this last downturn, that President Xi was trying to juggle a lot of balls. Whether it's addressing income inequality, maintaining growth, maintaining financial stability, and then COVID hit, and it's been really, really cloudy. In the past, what's always been the case, China, once growth starts slowing, basically China steps on the gas, steps on the accelerator, gets growth going again. But they've been very circumspect. They have maintained a much more targeted approach. And I think that's because they see a lot of financial excesses, getting in dangerous territory. As you mentioned, there's been social unrest there related to the property sector. Bottom line, I think China muddles through, as always, but it's not as clear as it's always been. I think that the reliance on China as an engine of growth for Asia is no longer there. And so to answer your question, I think a lot of the economies that are dependent on mainland China, that would be Hong Kong, obviously, Korea, Singapore, Taiwan, I think they're all in for a bit of a rocky road. The good news is that the fundamentals are very strong. They all have basically have current account surpluses, strong external positions, et cetera. But I think for equity market investors, I think it's going to be a little bit tougher road ahead for emerging Asia.
And based on that, and based on some of the weakness that we've seen on a fundamental level from the emerging world, there is a question of why it has delivered some of the best returns. If you take a look at carry trades executed in euros, they've returned something like 29% so far this year because of the deterioration in the euro. How much longer can that kind of trade continue, just purely based on where the euro is?
Sure, that's a great question. And obviously with carry trades, always the funding currency is always key, right? If you use the dollar, you'd have suffered obviously massive losses. I think the yen was popular for a while, but that's obviously we've had a 7-8 big figure move in that. That's kind of called into question. Euro, I think, has some room to go. In terms of being a funding currency. Again, I alluded to this earlier. The fundamental outlook there is simply put just awful. The market's been dialing back ECB tightening expectations. I think your wonderful MIPR page is showing a peak ECB deposit rate of, I think, 1% currently, down from over 2% just several weeks ago. So that's reflecting not only the ongoing slowdown in the Eurozone, but also the risks of the energy shortage in the fall. So again, it's really handcuffing the ECB's ability to tighten. I think that's going to be manifested in further euro weakness. We touched parity early last month. I think that trade is still in play. So to me, though, I think EM is still dicey, though. I think it's when you have slowing global growth, possible global recession, tight global liquidity conditions. It's very tricky. To me, it's like trying to catch a falling knife. Euro trade has obviously worked, but it's risky. I'm very defensive on EM right now.
Winston of Brown Brothers Harriman, trying to catch a falling knife. TK, I remember talking about the Swissy maybe 10 years ago, and it was like putting your hand in a blender. That's what someone told me. It was that ugly. Tom, I have to tell you that when it comes to the Federal Reserve, the debate at the moment is really divided. But when it comes to Europe and the ECB, it is so one-sided. I don't know a single person who really believes this ECB can go that far. And the window for most people just seems to be getting smaller and smaller and smaller.
I was upset this weekend, John. I'm glad you bring this up, because the U.S. newspapers that we now all read on the web are trying so hard to do softer sort of news stories. And they sort of bury that there's a war going on. And that's what they're dealing with in Europe. There's a war going on. I saw the petrol prices, John, for Sweden and the United Kingdom. Wow.
Brutal.
Brutal. Yeah. That's the correct word.
And energy prices in the mainland on the continent, in the Eurozone, could get a whole lot worse.
Yeah,
could get a whole lot worse.
So I think it's a completely different analysis. You talk about rent worries here. Yeah, we have rent worries here. Nothing compared to what they're dealing with in
nowhere near, Tom.
Europe.
Nowhere near. Nowhere near. And they haven't had the snapback, the recovery that America's had as well. And that's been an issue.
And that's technology overlay. We have the technology overlay. They don't.
Futures down a third on the S&P. We're down 0.2 on the NASDAQ. Your euro-dollar story shaping up as follows. Up by a little more than 0.1%. Positive on that currency pair, 102.37. Cruise down about 3% at 95.70 on WTI. From New York City this morning, good morning. Hello, August. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife. Come here, let me show y'all something.
No one covers the world like Bloomberg.
You have to show action on behalf of the American people, and that's exactly what the president is doing.
The major fault line at this early stage is tax.
For the oil market, this is a big moment to see if the kingdom is willing to step in.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change.
Reinventing climate news on TV, Quick Take, and Bloomberg.com.
Tons of economic data this week. From New York City this morning, good morning. The ISM manufacturing data out a little bit later, some PMIs, ISM services, JOLTS, jobless claims, then on to Friday payrolls, and on to next week, US CPI. Futures right now, a third of 1% lower on the S&P, on the Nasdaq 100, down a quarter of 1%. Some brilliant columns out on Bloomberg Opinion today. This just in from Mohammed Al-Arian. Here's the first line. July, an illustration of the adage that the market is not the economy. You think in a big way. That seems to be the takeaway. And then this from Bill Dudley a little bit earlier this morning, the former New York Fed president. Investors have lately become strangely optimistic that the Federal Reserve won't have to tighten monetary policy much further. He goes on to say, this wishful thinking is both unfounded and counterproductive.
I'm sorry, John. I'm speechless after a headline I just saw. John, you got to help me translate this, folks. We've got to get this.
Well, I haven't seen it, so how can I translate it?
John, it's just out here. PepsiCo to take 8.5% stake in Celsius for $550 million. Isn't that a crypto company?
That's a fitness drink maker, Tom, apparently.
Celsius?
I've never had it, so I can't comment.
It's a competitor of Tang.
It's a competitor of Tang. Oh, they could have bought Tang because I'm loaded.
Do we cover $550 million deals here, Tom?
I don't think we do. I just saw it and thought of crypto. I'm like, okay.
Okay.
Anyways, we'll have much more on that from our crack corporate team.
Is that why you wanted to cover it? You thought it was a crypto deal from PepsiCo?
You know, they'll no doubt do a better job than I just did there. I just went down in flames there. I'll probably get hate mail.
Why did you drag me down with you? That's what I want to know.
It was a group effort. We weren't trying to get Bramo involved. And Bramo said, no, no, no. Stephen Whiting always says, yes, yes, yes. He's chief investment strategist and chief economist, Citi Global Wealth, but far more, he links profit into our economy truly like no one I've ever met. Stephen, you are the guy I want to talk to. Link in the earnings surprise in a 6-week bull market with Chairman Powell's economy. Take the profit and tell me what it means about our economy.
Well, the one thing I just heard from the comments earlier about, July or the stock market isn't the economy, a month is not a quarter, it's not a year. We had a quarter past where there was still lingering strength. You'll see employment gained in the month. And we're decelerating from a high level of production and employment gains. So the fact that profits are up 6.5% over the past year shouldn't be so much of a surprise. There is a bit of a squeeze going down on costs, sort of lower in the value chain, are going up more than the top line, and we're going to have a weaker period of profits in the year ahead. But if you were worried about the period we're just in, I wouldn't get too excited about that being sort of the terrible period. Like, that's all over with now. Now, when it comes to Chairman Powell, I think, again, the one thing that I would take away that's a little more positive and was a reason for investors to perhaps not really, jump out of the window was the fact that there's some recognition that the economy is not going down the way they expect. If you take a look at total home sales in the U.S., new and existing home sales, we're down 26% in sales from the peak. If you combine these figures, there's plenty of signs that there's interest rate impact, leading edge knocking the economy down now.
In your notes, Stephen, we hear what we're hearing from others, which is avoid the cyclicals and such. Tell me how technology in the retail bet, as the Journal writes up today, how the technology bet is the non-cyclical play. It's what you want to be in, given where we are right now.
Well, there are some technology cyclicals, and then there are some others. I would put advertising spending in the cyclical category, personal computers to home electronics, this sort of thing, tech services, cybersecurity, enterprise software, these things much, much less cyclical. I would look at it and say, look, we have had a sizable drop in long-term interest rates already. Now, again, what are we talking about? 3.5 down to 2 3/4 or so. But the signs are there that we're going to have a low-level peak in long-term interest rates. And probably for the bulk of the secular technology area, we're probably going to have a fairly high-level trough. So a lot of the risk, the idea that just commodity prices can go up forever, the economy can have an inflationary boom, we're just going to fight that. I think those are the areas that we would think that are a little bit more vulnerable now. So again, a little bit of drift here towards high-quality growth, which we can understand, but I don't think it's really that moment where we can say, well, the profit outlook is really improving for these firms too.
So embedded in what you just said, Stephen, are you basically saying the energy companies have seen peak valuations, that it's time to lighten up there?
Well, we did, for example, remove our overweight in oil field services. We're not seeing that industries like natural gas, LNG, a lot of some of the things that we are sadly in short supply because of the war in Eastern Europe are really poor investments. The valuation really isn't too troubling at this point. But the idea that we're not going to suffer at all in the commodity space because of Fed tightening and a slower global growth rate is a little bit too much. So, yeah, we've taken down some weightings there a bit and do think that, again, a harder landing for the economy is going to be felt throughout a lot of cyclical commodities.
So the Fed Chair Jay Powell spoke a lot about being data dependent, and we discussed a lot on this show. What does that mean? What data are they looking at? Can you give us a sense of what happens if the labor market data, if the jobs report that we get on Friday comes in hotter than expected? What kind of effect that would have on the equity markets?
Well, look, it means that the Federal Reserve is unlikely to be kind to the equity market, that it's not there, again, to protect investors. It's to protect labor markets and to get us to a lower level of inflation. But I would say, again, some of the signs that we have seen, being data dependent is a lot better than the Federal Reserve being overconfident in the economic outlook. And what we have seen with unemployment insurance claims up about 70,000 from its low point on a trend basis, that doesn't happen when the economy is growing at its potential, right? When the economy is growing strongly at trend, we don't get rising unemployment insurance claims. Now, the point that we're already expecting declines in the labor market is pretty far off. It's probably into next year. But I would say that, again, the way financial conditions have tightened, the way the lags play out, it's quite possible, again, that we're facing job losses on a net basis over the course of 2023. And if the Fed's going to be data dependent and instead looking at inflation issues, some of these inflation issues are really lagging indicators. Services price inflation, most closely linked to wages, has had little to do with the inflation spike of the past year. And it's a member of the index of lagging economic indicators. Unfortunately, those things are going to still show some strength. But eventually, the Federal Reserve is going to come around and say, well, you know, the fuel is out of the tank for inflation. And so how far do we want to push this? Must you crush the economy and, again, get ourselves into an easing cycle? Really, is that really the approach that we need?
Stephen, with great respect to ask this question, how flexible are corporations here, given what you just laid out, and given all the worries everybody has, particularly Lisa Abramowitz? How flexible are corporations to adapt?
It's a great question, and there's adaptation going on, but there's probably not some planning, you know, for some massive deterioration in demand. So they're going to be a little flexible, but I don't think that we can avoid some loss in profits in the coming year.
Steve, can I just get a sense for how confident you are? Where you think the next 10% move is from here? Lower? Higher? You've got a degree of confidence around that story?
You know, I think coming up with answers is different from knowing. And, you know, there's a few things we knew. We knew that an exogenous shock is not going to have the same effect as a business cycle. I think a great deal of the inflation that we've already experienced doesn't have a life of its own. I don't think that forcing supply and demand down together really cures this problem. But I have regular confidence exactly when the Federal Reserve stops and sees that. So I think that we want to err on the side of caution a little bit. And that's what we're doing with portfolios. It's not a period when we can say the economy is at its weakest point and is able to recover again. That I'm sure of.
You're not alone. Steve, good to catch up, sir. As always, Steve Whiting there of Citi Global Wealth Investments. Coming up in the Open, as we count you down to the opening bell on Bloomberg TV, we'll be catching up with David Leibovitz of JP Morgan, among others, including Judy Bill and James Athey. That's all coming up in the next hour, Tom, on Bloomberg TV. Looking forward to it.
You're probably going to dive into this transaction of Celsius and Pepsi.
Without a doubt. What have you learned about that transaction?
I've been learning a lot here. Riley, thank you so much for emailing in from St. Louis. She's addicted to this garbage. John, they have kiwi guava sparkling Celsius Live Fit. They have Celsius Heat. They've got... Lisa, have you ever had this stuff?
No.
I'm reading about Arctic Vibe, Tom. In that is a lot of caffeine and ginger root, and it's fortified with vitamin B and vitamin C, or you might say vitamin B and vitamin C.
You know, I was just talking to John Fieldley about this, and of course, congratulations on the transaction. It really shows the, you know, the entrepreneurship and all that. And I said, you know, I think a natural for me is Celsius take an Uber. That would be, you know,
you think they should take Uber?
No, I'll take the Uber.
Okay.
But it's you know, you have your beverage while you're taking
I've got no idea where we're taking this.
John, you take your Uber instead of fitness.
Instead of working out, okay.
You've never done that,
right.
I know,
sure.
But some of us have.
I'm on board. Bramo's got issues with this segment.
No, I just, you know, would we be discussing this if you didn't think that it was the crypto name? And I do wonder, there are a number of acquisitions this morning that are interesting, though. This idea that we are finally seeing some activity in capital markets is interesting because there had been so little for most of this year. The rally that we saw in the past month is actually giving way to the Apple transaction, to the acquisition of Valvoline.
That was very sensible.
That's actually a really fascinating development.
Well, Lisa, John took a call on the break. I wonder if he was taking some paper down.
That was very sensible. What are you implying? Why are you always doing this?
It's a 40-year piece, says you.
I might not be back tomorrow. We're down 0.4 to 1% on the S&P. You're happy with that, I know. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden is isolating at the White House after testing positive again for COVID. He has a so-called rebound case that is seen in people who take the antiviral drug Paxlovid. The White House says the president is not experiencing any symptoms. In eastern Kentucky, the death toll from massive flooding has now risen to 28, and the state says more fatalities are expected. Rescue and recovery efforts were slowed Sunday by up to 4 more inches of rain. About 400 people have been rescued by National Guard helicopters. Google, General Motors and Verizon are amongst the 68 companies backing affirmative action in upcoming cases before the Supreme Court. The companies have filed a brief with the court supporting programs that are being challenged at Harvard and the University of California. The cases are first on affirmative action to come before the court since conservatives gained a 6-3 majority. And Apple is tapping the high-grade bond market with a sale in as many as 4 parts. The money, they will be used for a number of purposes, including share buybacks and dividends. The longest part of the offering, a 40-year security, may yield up around 150 basis points over treasuries. And PepsiCo will pay $550 million for a stake in fitness energy drink maker Celsius Holdings. It's part of a long-term distribution agreement. PepsiCo is getting convertible preferred stock equating to 8.5% ownership in Celsius. The company will also nominate a director to serve on the Celsius board. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth. And codifying that using AI, sensors, and computers is turning out to be a lot harder. Last but not least, it's a safety critical system. None of us should deploy until and unless we have closed loop evidence that we're safe.
In a a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's going to make inflation worse, actually. So they've got a big corporate tax increase that's going to probably make this recession that we're in worse. All of this spending is unnecessary. It's going to exacerbate inflation. It is not going to reduce the deficit.
Face the Nation with CBS. That was Mr. Toomey of Pennsylvania, of course, talking about the moment at hand and the domestic debates that we have. Sometimes you get lucky in your scheduling. We do that with William Cohen. To say he's chairman and chief executive officer of Cohen Group barely describes it. He's a former Secretary of Defense and, of course, his public service and really bipartisan approach here. But far more back to Nixon, Kissinger on China. He, among few, is on the high ground. Maybe Mike Mansfield up in Japan would be somewhat the equivalent. Secretary Cohen, we're honored to have you here today. Is Speaker Pelosi making the right decision if she travels and lands in Taipei and greets the Taiwanese people?
Well, I think what we have to do is understand what our policy towards China is and what our strategy is. We have taken a one China policy as far as the last 50, 60 years. And the question then becomes, what is our strategy for implementing that? Do we make a decision? Do we want to have any kind of a positive relationship going forward? And if so, how do we get there? And so I think what has happened with Speaker Pelosi's trip is she has raised very high expectations in Taiwan, very high anxieties in China. I believe that how we deal with Taiwan is a very big, bright red line as far as the Chinese are concerned. And I think they will respond, if not militarily. I don't expect that to take place if she should go to Taiwan. I think they will find a way to respond in their own fashion that will inflict some harm upon us. So it's got a tough decision to make. The military has apparently indicated it's a rather dangerous time for us in the region, and she'll have to take that into account.
In the arc that we have of our relationship with China, a one China, and with Formosa, with Taiwan, there have been assurances, 6 assurances over time. You were directly involved with that. How strong are our 6 assurances to Taiwan?
Well, the assurances are inconsistent. With the passage of the Taiwan Relations Act, and I was a part of that going back to 1979, we said that we will help provide for the defense of Taiwan. Since that time, President Biden has said we will defend Taiwan. That has caused great confusion in terms of not only with China, but also our Asian allies. All of those in the Asia-Pacific region, or now the Indo-Pacific region, are concerned. What does that mean? Are we prepared to go to war with China over Taiwan? And will they be with us? So we have to get more clarity in terms of exactly what we're prepared to do. Is it just help provide defensive equipment or actually go to war should China try to attack Taiwan? So there's confusion. There needs to be clarification. And that's something that I would think that Speaker Pelosi has talked with the administration, has talked obviously to the military. And I think during this trip, she needs to talk and will talk with all of our allies in the Asia-Pacific region, because they have a lot at stake in terms of what we'll do and what we'll fail to do should there be a conflict.
Secretary, as the tensions begin and continue to really escalate in a new way between China and the U.S., is the U.S. dealing with a weakened or an emboldened Xi Jinping, a strengthened Xi Jinping than perhaps a few years ago?
We defend democracies. We defend human rights. They will see this as pointing a finger in the eye of Xi Jinping. And I think when we talk about red lines, going back to red lines with Russia, for example, going back as early as 2003, Bill Burns, our current CIA director, wrote to the Bush administration, said, Russia will see any move on the part of Ukraine toward NATO or EU as a red line that they will not allow Ukraine to cross. Well, that was 20 years ago. I think from my travels in the entire region, China will see this as a red line, and they will find a way to take reaction to the United States that will in some way impact negatively upon the U.S. and our allies. So it's one of those issues. The Chris Christopherson song, is the going up worth the coming down? We will have to decide, is the going up in terms of ratcheting up the tensions with China worth what's coming after that? What will be the nature of the relationship? Will we still be engaged with China? Or do we want to follow a policy of decoupling? Can we pull our economic engagement with China out? And if we pull out, will the European allies pull out? Will the Southeast Asian allies pull out? Yeah. So these are all issues tied up with our relationship with China. So it's not easy. It's very complicated.
Secretary, just quickly here, do you think that this trip by Nancy Pelosi is advisable or a grave mistake?
I don't know the answer to that. I would think that one option would be to say that she will visit Taiwan, but perhaps at a later time. That would be one option. But she may feel that she's compelled to do so now. But understanding what the risks are, I think it's going to be complicated again because of expectations that she's being pushed by Republicans and Democrats to go. I think the administration is flashing a warning sign without telling her not to. So the decision ultimately will be up to her. But I think it does, it certainly has some grave dangers involved. There are many who feel China's bluffing. I don't think China's bluffing.
William Cohen, thank you so much. We look forward to speaking to you again, particularly on the U.S. military in a fractious 2022. William Cohen, he's a former Secretary of Defense for the United States, and of course at this historic moment. Lisa, really, really extraordinary how it is multiple fronts for our military.
Yeah, and how this is the ratcheting up of tensions that people do not really want right now in terms of yet another geopolitical point of tension. I also think that what Bill was saying there, what William Cohen was saying in terms of whether a military altercation and a ratcheting up of tensions escalates the decoupling of the U.S. and China is a fascinating point that really speaks to the economic place we're in.
That's right, that's where I go.
Does that
Absolutely.
End up leading to a longer-term inflationary push as the U.S. brings more of the activity back home? And we are seeing companies that do come out with reshoring plans get rewarded in the stock market. How much does that become a real theme heading into the next 12 months?
And right now, a headline coming out on Speaker Pelosi. Brad, help me with this, please. The Speaker of the House to land in Taiwan Tuesday night and meet lawmakers Wednesday as well. She'll be, I believe, in Taiwan. That's just breaking. We'll have much more on that across all of Bloomberg here through a most interesting Monday. Lisa, I've also got to go back to bond yields a little bit elevated here with an incredible economic data flow this week.
How much is this an expectation of a lot of pushback from Fed members who are planning to speak starting tomorrow, basically saying, guys, don't get too excited. It's not like we're going to start cutting rates tomorrow.
Very good. Please stay with us. The futures at negative 25. The VIX out a large stick, 22.76. On television and radio, this is Bloomberg. Good morning.
This week on Bloomberg Green, the green energy of the future, how to make clean hydrogen and its benefits for the planet. Flying high, we take a look at the practical uses of green hydrogen as jet fuel.
To hydrogen fuel cell being the best approach from the cost of fuel, efficiency of utilization of the fuel, and the mitigation of the climate effects.
And from a small part of the energy picture to making it available for all. We talk the challenges and opportunities in widening access to green hydrogen.
My biggest dream is to see green hydrogen become mainstream, actually, and not just to have these little pockets of applications or these demos, but for it to really become the fuel of the future.
From Bloomberg's world headquarters in New York, I'm Kaylee Glines, and don't miss the latest edition of Bloomberg Green, airing this weekend on TV, Quick Take, and online.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Leaving behind a monster month of gains. Hello, August. Live from New York City this morning. Good morning, good morning. Futures fading, down about 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Fed watchers pushing back.
The notion of a coming Fed pivot.
That Fed pivot. The pivot that everybody's talking about.
Central to this is the view that there'll be this immaculate disinflation.
We still see core inflation accelerating.
This was not a pivot from the Fed.
Inflation is still what we need to be focused on.
I don't think Fed is pivoting here.
You don't see it.
Chair Powell, in his unscripted remark, said we are at neutral.
I'm not sure why Powell stated that we are near it.
They are selling enough optimism to the markets.
The market is looking for a pivot.
The market is trying to force the Fed's hand.
It's too early. Financial markets seem to be pivoting prematurely.
This is a market that's trying to always get ahead of the Fed.
Joining us now to discuss Aberdeen's James Athey, Julie Beale of Kane Anderson Rudnick. We're getting pushback from current and former Fed officials. Julie, I want to go straight to the column we had from the former New York Fed President Bill Dudley this morning. He wrote the following: investors have lately become strangely optimistic that the Federal Reserve won't have to tighten monetary policy much further. This wishful thinking is both unfounded and counterproductive. Julie, how self-defeating is this rally we're seeing play out?
Well, I think it could lead to a lot of heartbreak the way that things are set up. We would all love to be further through inflation than I think we already are. And the optimism is really based on the fact that things look very cheap after declining 50, 60, 70%. But they're cheap for a reason. They were expensive, and now they're probably at more reasonable levels. And I think what we have to remember is that the Fed tried to be pretty cute about inflation, calling it transitory. And now it's just giving us a lot of mixed messages. And I think the reason for that is we just don't know how the data is going to turn out. And so they need the breathing room, they need the flexibility to be able to make changes as the data comes in. And I think the problem for investors is we just want a lot more certainty than I think is really available to us right now.
James Athey, does this Fed need to smack this one back down?
It amazes me, really, that
for an institution which spent so long talking about financial conditions as the metric and the transmission of its policy, how little they seem to understand financial markets. Of course, the market is keen to get to that pivot point quickly, and of course, the market wants to be ahead of the Fed, ahead of the economy, etc., etc. But the whole reality, if you like, of financial conditions is that if the Fed allows the market to begin to think about what happens when inflation peaks and starts coming down, then it already becomes self-defeating, because you get an easing of policy at a time where the Fed should still be tightening. So, as usual, their communication is what gets them in a problem. And I completely agree that this rally is self-defeating. Everything that's going on is exactly the opposite of what the Fed needs. Lower yields, steeper curve, weaker dollar, higher commodity prices, higher equities. This is basically another boost to an economy which is already overheating and driving inflation towards 10%.
James, Connor Sense said this morning on Twitter, a Bloomberg columnist. He said, where their problems stem from is affirming that long-term neutral rates are around 2.5%, which anchors the 10-year yield around that level, which anchors mortgage rates, which supports housing. They're not sure how to make markets do what they want. Does that resonate with you, James?
Yeah, what resonates with me is what Jerome Powell was saying back in 2016, 17 and 18. And to be honest, what he was concerned about when he was a governor back in 2012. In 2017, 18, he told us to do away with the stars. These are absolutely useless. Nobody knows where they are. Nobody can measure them in real time. They are highly theoretical concepts, and they are no practical use whatsoever for a central bank or for investors. I'm not too concerned about the idea of neutral. I am concerned about the extent to which rates where they are or rates where they're going to slow the economy a lot, increase unemployment a lot, and therefore ultimately destroy demand and bring inflation down. And I think that's a process nobody will know. In the meantime, you need to continue tightening policy until you see that material progress towards 2% inflation, and already giving the market some hope about immaculate landings, soft landings, and perfect policy is going in completely the opposite direction.
I tell you, futures fading right now, down 0.8%, 25 minutes away from the opening bell. You remember a few hours earlier this morning, we had a report from CNN that Speaker Pelosi is expected to visit Taiwan as part of a tour of Asia, according to a Taiwanese government official and a US official as well. Further reporting from another outlet in the last hour, looking for the same thing to develop. So we're down about 0.8%. Anne-Marie standing by down in DC. We'll catch up with her a little bit later. The other story over the weekend, the pushback not just from former Fed officials, but current Fed officials as well. The Minneapolis Fed President Neil Kashkari weighing in. Take a listen.
We're going to do everything we can to try to avoid a recession, but we are committed to bringing inflation down, and we are going to do what we need to do. And we are a long way away from achieving an economy that is back at 2% inflation, and that's where we need to get to.
Mike McKee, more work to do.
More work to do. And I wouldn't say that they're pushing back in the sense that they're just reaffirming. Nobody said that they were going to cut back on their rate rise increases. They just said they want to be data dependent. And this is the data. Let me, before I go to the week ahead, start with this. This is what really matters and is going to frame the debate. Those are two different measures of financial conditions. And as you can see, they've started loosening again. In part, to go back to the question you asked Julie Beal, it's a self-defeating rally in the markets because it's loosening financial conditions, and that doesn't help the Fed. So that is the context for this week's numbers, and this is the first week of the month when we get the big numbers. Today, S&P manufacturing PMI, and of course, ISM manufacturing. Everybody's going to be looking not only at the headline number, but at the prices paid number, and we'll take a look at the employment number to see maybe what we can tell about Friday. Tuesday, 3 Fed officials. They will add, no doubt, to the same comments that we heard from Neil Kashkari. Then you get jolts. We'll see how many jobs there are. And did we see a drop in auto sales because of higher rates? ISM services on Wednesday, Thursday, jobless claims, and Friday's the big day. And as you can see, we're expecting a drop in the number of jobs created, but no change in unemployment. And 250,000 is still a lot. So at this point, everything is pointing to the fact that the Fed still has to do a lot more, and I wouldn't bet against 75 basis points at this point, particularly given the fact that financial conditions are loosening.
Mike, is it too early for me to ask about August 10th and the next CPI print?
It's not too early. We may see a drop in the headline because, of course, we saw a drop in gasoline prices, but a lot of other numbers have suggested that underlying inflation is gaining steam. So the Fed still has a lot of rooting out to do.
Long path to the September meeting. More data still to come. A CPI report next week. Payrolls on Friday, as Mike McKee said. Mike, thank you. Then on to Jackson Hole later this month. Going to be alongside Mike McKee over in Jackson to weigh in on all of this a little bit later this month. Mike Wilson of Morgan Stanley weighed in on some of this. He said this: the equity market can dream and will dream of a better future as rates come down from a potentially more dovish Fed until it's proven wrong by the estimates collapsing, as they always do, in an actual recession. Julie Bill, we're trading on lower yields now. When do we start to trade on why yields are lower?
I think it's not just a question of yields, but I think a lot of it has to do with spreads. I think we have to keep in mind that the fundamental picture is deteriorating. And I think as earnings start to come through, what we'll start to see and hear and pay attention to is sort of like when you're on a date with someone for the first time, everyone is talking about, everything they've accomplished and how great they are, but the future seems kind of uncertain and they can't commit to anything. And I think that deterioration is what the recession will look like, just a gradual collapsing in how fundamentals are going to play out and strength of earnings and margins, in particular with inflation, that really has to start to play out.
Julie, I'm not going to dig deeper on that particular analogy. I'll go to the next question. What's bounced back too hard, too fast, in your opinion, in the last month? And what would you be more willing, more confident to fade?
I think a lot of the cyclicals have been surprisingly strong, and it doesn't make a lot of sense to me, particularly when you think about the makeup of the U.S. economy. It's a consumer economy primarily, and so a lot of these cyclicals that are touched by consumers, I don't see as being very strong. For us, it's not a question of being very defensive. It's just a focus on quality and businesses that are less tied to the consumer. I think that's a much better place to be.
You've had a call on retail for a while, and our pandemic demands seemingly are being fulfilled at a point where they're no longer desired. And these retailers are now sitting on tons and tons of inventory, Julie. How do you think that's going to play out through the sector, through the year ahead?
I think I just recently visited the ports of Los Angeles and was absolutely stunned that there is 100 acres that used to be a vacant pier that is filled completely with shipping containers. And these are not ones that are looking for truckers. The retailers don't want them because their own warehouses are full. And I think that portends really poorly for back to school and for holiday, frankly. This is something that's going to maintain over a long cycle. And now you have a timing issue where the inventory is actually not where it's supposed to be when it's supposed to be because of the delays. So I think it's problematic and it's going to last, and it's going to cause a lot of pessimism because people are going to be very aware of the situation and how negative it could be.
Julie, where does that leave the off-price retailers? Is this a blanket bearish call on the whole segment, more broadly across the whole industry group, or is it concentrated around particular names?
I think anything that sells something that has a barcode on it, where you are in the Hunger Games with Amazon, is not something I want to be in. But off-price has really been struggling for a while because they haven't been able to get inventory. And now let me tell you, they're going to have plenty of it. And at the end of the day, the U.S. consumer loves a deal. So, you can be looking at your TJs and your Ross, but I think even better is if you're in more of a general merchandise category. So something like an Ollie's Bargain Outlets or a grocery outlet, I think, is even better positioned.
This is the issue, James Athey. We've all been asking this question over the last month. The retailers and what they're going through right now, is it just an execution problem, or do we have serious signs of a weaker consumer in America?
Yeah, I think there's definitely elements of both, quite clearly. What's happened post-pandemic and the just-in-time global supply chain shock and working through the after effects of that is obviously playing a huge part. But realistically, I think, unfortunately, there was a lot of extrapolation of unsustainable demand, and therefore you've ended up with this massive inventory overhang. So I do think that a good chunk of it, certainly the more recent build-up in wholesale and retail inventories that we're seeing, I do think that relates to massive weakness in consumer demand. It's inevitable. 50% of US consumers, 50% of people who are submitting federal income tax forms really don't pay a huge amount of federal income tax because they don't have a whole huge chunk of discretionary disposable income, and the price of the things that they are forced to consume, that they have absolutely no discretion around, has gone through the roof. And of course, they have to cut back somewhere if they're not prepared to put that on a credit card, which concerningly a significant number seem to be. So unfortunately, this was always where we were going to end up. The speed at which we've got here, I think, has surprised some of us. But the reality is the jobs market, on the face of it, still looks relatively strong, and that means we've got further weakness ahead.
Jobs market data still ahead. James Athey, Julie Bill sticking with us. Futures down about 6 or 7 tenths of 1% on the S&P 500. Last month, the S&P up 9% over last month. A monster move. Looking at Treasury yields, we've come back a mile from where we were on June 14th, close to 350 on a 10-year. Right now, your 10-year yield down another basis point to 264, sub 264, 263.78 on a 10-year right now. About 18 minutes away from the opening bell. Let's get you some movers. We can do that with Abby.
John, well, relative to U.S. futures, that S&P 500 in particular nosediving right around 8 a.m. It has to do with one stock, because ahead of the announcement that Apple is doing another 4-part bond sale to fund both dividends and buybacks, the S&P 500 had been slightly higher, but you can see Apple itself down about 0.9%. This is the 5th bond offering in 2+ years. It's interesting to note those other 4 times the stock did close higher. Boeing popping nicely higher, up 3.9% on the possible St. Louis area strike being on hold until at least Wednesday, room for new labor contract. Plus, they have the possibility of more 787 deliveries could resume after a hurdle with the FAA being cleared. HSBC sharply higher, up 7% on a surprise earnings beat, plus plans to resume the dividend. And then finally, Celsius, the holding company for low-calorie drinks. PepsiCo is taking an 8.5% stake, a $550 million stake at $75 per share, John. There is, however, a 15% bearish short interest on the shares of Celsius, so that probably helps to explain that big pop higher.
That is the sound of a squeeze that you hear. Abby, thank you. Tom, very excited about that story. I've got no idea why. As Bremo pointed out, just some signs of corporate activity this morning on the debt side with Apple and then again with PepsiCo on the equity side, as Abigail pointed out. Coming up, the story of the moment, Speaker Pelosi's potential visit to Taiwan.
I'm very excited should we go to the countries that you'll be hearing about along the way about how the conversations we have now.
The list of the countries on her tour coming up next.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is fighting inflation. This is all about the absolute horrible position that people are in now because of the inflation cost, whether it be gasoline, whether it be food pricing, whether it be energy pricing. And it's around energy mostly driving these high inflation. This is going to take care of that because this is aggressively producing more energy to get more supply to get the prices down. That's what we're doing.
Things getting a little bit better for the president at home, a little more contentious abroad. At home, looking to pass the Democrats' new Inflation Reduction Act. Abroad, Speaker Pelosi heading to Asia amid simmering tensions with China. CNN reporting that Speaker Pelosi is expected to visit Taiwan, citing unnamed Taiwanese and US officials. Down in D.C., let's get to AMH. Anne-Marie Moore reporting from the Liberty Times in the last 30 minutes that the Speaker of the House is expected to land in Taiwan tomorrow night.
Yeah, and exactly, Jonathan. That's just about 24 hours from now because she's in Singapore where it's 9:15 p.m., where it also is in Taipei. And Liberty Times is one of the main newspapers in Taiwan reporting that the Speaker of the House will be coming to the country. Jonathan, we heard it already this morning from China's foreign ministry, the same kind of rhetoric we've been hearing for days, saying that the PLA will not sit idly by if Speaker Pelosi comes to Taiwan, given her rank as the third highest level official from the United States. And already over the weekend, we saw live drills in the province directly across from Taiwan. And we should note that today, the People's Liberation Army, China's army, the PLA, is actually celebrating their 95th anniversary. So tensions are very high at this moment, at potentially this trip, which we should note over the weekend, Speaker Pelosi in her itinerary did not foreshadow this. This was one of the items left off.
Anne-Marie, we caught up with Isaac Bortansky last week of BTIG. Take a listen to what he had to say about this potential visit.
It feels incredibly difficult for her to pull back at this stage. My sense is that she's going to have to go to Taiwan. As we see geopolitical tensions continue to mount with China over Taiwan and over other issues, the most that we're going to see are these targeted, narrow set of tariff relaxations focused on consumer goods.
AMH, he called this a lose-lose situation. Is this a lose-lose situation?
So for Beijing's side, they're talking tough rhetoric, which basically means there's a risk that there could be potentially some dramatic influence from the PLA with Speaker Pelosi's trip. What they exactly do, we do not know, but maybe some intimidation. And then, of course, on the U.S. side, this is difficult because now that this was already put in the press, it was also supposed to go in April, but she got COVID. How does she walk this back? Her Republican colleagues are actually also pushing her to make sure they take this trip. So if she calls it off or the White House asks her to call it off, then the United States looks like they are not talking tough ahead to China, and we are about 100 days out from the midterm election. So for both sides, it could potentially be a lose-lose, and it is a huge risk. We should also note, while this is happening, you have delegations from China and the United States also working on the first in-person meeting for Xi Jinping and President Biden of his administration.
That's getting harder and harder to sort out. AMH, Anne-Marie down in D.C. More from Anne-Marie through the day on Bloomberg TV and on Bloomberg Radio. James Athey, let me speak to the trader in you. How will you navigate this headline risk going into tomorrow and through tomorrow?
Yeah, I mean, it's tough, as with all headline risk, right? You just see, I don't know, the comments from potential Italian Prime Minister Meloni on Friday and the effect that that had on BTPs and BTP spreads. There's no way you could have known that headline was coming. There's no way you could have managed that risk. Unfortunately, it's likely to be a bit similar with the Taiwan situation. It feels entirely unnecessary to me. I agree with Anne-Marie that at this point, you're damned if you do and damned if you don't, but showing weakness at the very last minute is probably, from a political calculus, the worst option. Therefore, I would guesstimate that the risks are towards risk-off downside headlines, and particularly given, equities have squeezed all the way up to the 100-day moving average in S&P and look particularly prone to me given the deteriorating growth and earnings outlook. So it's not something I'm going to try and position for. It's something I'm going to be aware of. I think the risks are in my favor because, broadly speaking, I'm defensively positioned. But, it's just one of those you'll just have to watch and see bombs go off if and when. And by bombs, I, of course, mean headline bombs, not actual bombs.
And equities down, and down hard. Futures down by 0.7% on the S&P 500. Judy Bill, you look abroad right now, you've got the situation with China over things like Taiwan. You've got the situation within China. The data's not great at all. You've got the FX backdrop of a strong dollar through much of this year, the weakness in Europe. Judy, from your perspective, do you just focus at home? Focus at home and look at what's happening here and try and push out some of that?
Yeah, I mean, I think if you look broadly speaking, I would prefer to stay domestically focused, particularly on smaller businesses that are easy to understand and that have a better control over their destiny. Having FX into the mix makes things extremely complicated. And I appreciate that investors say, well, that's fine. We're just going to look at constant currency results. But at the end of the day, If your product is more expensive because of currency, it's less competitive. So for us, we're definitely focusing on companies that are at home. It makes it easier for lazy people like me. That's a good thing. And it makes it easier too, because I don't need to keep track of Nancy Pelosi's vacations. I just wish she'd take a Carnival cruise like everyone else.
I'm sure certain officials down in DC might share that sentiment right now. Judy Bill, James Athey, to the both of you, thank you. Right now, futures are down on this by 0.75% on the S&P 500. Yields look like this on a 10-year. We come in just a little bit. It's not a monster move. We're down a basis point on a 10-year to 264, and that's been the direction of travel pretty much since we topped on June 14th. Coming up, the morning calls, and later, JP Morgan's David Leibovitz does not see a pivot. He's looking for more Fed hikes. We'll speak to him around the opening bell from New York. This is Bloomberg.
This week on Bloomberg Green, the green energy of the future, how to make clean hydrogen and its benefits for the planet. Flying high, we take a look at the practical uses of green hydrogen as jet fuel.
To hydrogen fuel cell being the best approach from the cost of fuel, efficiency of utilization of the fuel, and the mitigation of the climate effects.
And from a small part of the energy picture to making it available for all. We talk the challenges and opportunities in widening access to green hydrogen.
My biggest dream is to see green hydrogen become mainstream, actually, and not just to have these little pockets of applications or these demos, but for it to really become the fuel of the future.
From Bloomberg's world headquarters in New York, I'm Kaylee Glines, and don't miss the latest edition of Bloomberg Green, airing this weekend on TV, Quick Take, and online.
5 minutes away from the opening bell in New York City this morning. Good morning. 5 minutes away from the opening bell with risk over Taiwan very much on the horizon, a focus for many market participants through the next 24 hours. Will she or won't she, the Speaker of the House, visit Taiwan? Futures down by about 6 or 0.7% on the S&P. For the bond market, some pushback over Fed expectations from both current and former Fed officials. Yields come in by not even a basis point. We're higher. We're moving the other way by a basis point on a 2-year to 289.64, down a basis point on a 10-year to 263.42. That's the story of the bond market. That's the price action. Here's some morning calls. Wells Fargo upgrading target to overweight, 195 price target, seeing an attractive buying opportunity following recent declines. Barclays downgrading Comcast to equal weight, expecting slower growth with cable providers starting to resemble telecom companies. And finally, Jefferies downgrading Bumble to hold, highlighting a challenging macro environment and worsening FX headwinds. They're three of the calls. Coming up, Wall Street divided following a monster equity rally in July. JP Morgan's David Leibovitz sees big tech starting to look a little bit more attractive. That conversation up next.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com.
24 seconds away from the opening bow this morning. Good morning to you. The market's shaping up as follows. Futures down 0.7% on the S&P. On the Nasdaq, we're down by about 0.6%. The focus on Speaker Pelosi's tour of Asia. Will she or won't she head to Taiwan? There's your opening bow. Switch at the board and get to the bond market. Yield shaping up as follows on a 10-year, down a basis point to 263.42 and way off the highs of the year. Close to 350 back on June 14th. That is when real yields topped as well. And the market bottomed, the equity market bottomed 2 days later. And we ripped on the Nasdaq. And then we went into July and had a monster month as well. We're coming off the best month of gains on the S&P since November 2020. Up 9% there on the Nasdaq 100, up by about 12.5%. Last month alone, that good. And off the lows of June, much more so. About 25 seconds into this, we are negative 5 or 0.6% on the S&P. Let's get you some movers. We can do that with Katie Greifeld.
Well, it's hard for the index to rally with one of the biggest stocks under pressure. That's the case with Apple today. Of course, shares falling after a report that the company will kick off a four-part bond sale, with dividends, buybacks in focus. Usually Apple rallies after these sorts of announcements. Not the case today so far. You also have onsemi lower. The chipmaker reported earnings earlier and revenue beat estimates, but the company said it's, quote, sensitive to dynamic market conditions. Shareholders seem to be taking that as bad news. We'll certainly see. Alibaba, meanwhile, also flipping from a gain to a loss. The company said it's going to strive to keep its U.S. listing. That's after it landed on the SEC's list of Chinese firms facing delisting. Shares can't really decide what to do, down about 0.5% or so. And finally, Boeing, though, it's solidly higher after a double dose of good news. You have defense workers delaying their strike by at least a few days or so. And Boeing also got the next step in deliveries for its 787 Dreamliners. That's been on hold since 2020. Shares up almost 5%, John.
Katie, thank you. About 90 seconds into this one, we are decidedly lower. We're down 0.6% on the S&P. On the Nasdaq 100, we're lower. On the Nasdaq, we're down 0.7%. This morning really started with the news report from CNN reporting that Speaker Pelosi is expected to visit Taiwan as part of her tour of Asia. They went on to say that this was according to a senior Taiwanese government official and a U.S. official as well. That was backed up a couple of hours later from the Liberty Times, who said House Speaker Nancy Pelosi is expected to land in Taiwan on Tuesday night local time. You saw the equity market gap lower. You saw this currency pair pop higher. That is dollar CNH. That's the offshore yuan. And right now we're seeing a move of about 0.6% to 678.92. This is going to be a big market story through the next 24 hours, and one we'll keep our eye on for you as these headlines pour in. We've got to keep our eye on earnings too. Another busy stretch of earnings, with 20% of the S&P 500 market cap reporting this week after recording the best month of gains since 2020. Let's get back to Abby for more. Hey, Abby.
Hey, John. Well, indeed, it is going to be a busy week for earnings. And with that big gain for the S&P 500 last month, not surprisingly, perhaps the overall headline for the earnings season so far is less bad or better than feared. And this, of course, as there were some beats, surprisingly, because there had been such a negative sentiment going into the June quarter earnings report. Sales beat by 2.1% on average, earnings by 4.2%, which is interesting. It tells you investors, or excuse me, companies' management teams are really managing to manage costs. And then, of course, there's the one-day move, not surprisingly, with that big gain for the S&P 500 of 9% in July, up 0.7% on the day. Now, this week, as you were mentioning, 20% of the S&P S&P 500 at stake, $2.1 trillion of market cap to report, mixed among discretionary and staple sectors, among others. Tomorrow we'll have AMD, Uber, Caterpillar, and Starbucks to give you an idea of industrials and discretionary companies that are reporting. And then healthcare, that's the one big single sector represented this week, $1.4 trillion worth of market cap. Eli Lilly and Amgen report on Thursday, CVS on Friday. But John, it's not just the micro, it's also the macro. You were talking about Nancy Pelosi's visit to Taiwan. We, of course, also have seasonality. Now, most folks tend to think that October is a worst month for stock given 1929, 1987, 2008, but it's actually August and September. Over the last 25 years, both of these in August down 0.6%. Don't forget Black Monday back in 2015 and 2011. We have a big crash, down 0.7% in September. And strategist Jonathan Krimsky over at BTIG, he thinks that July, it was just a counter-trend rally. Morgan Stanley and Goldman Sachs, as you know, agree. On the other hand, JP Morgan thinks that there could be some sort of positive outlook for the rest of the year. I think the main theme, the main idea, John, fasten the seatbelt.
This has been the move that Marko Kolanovic over at JP Morgan's been looking for a long, long time. Abby, thank you. Thank you so much. Looking ahead to the week ahead, we've got to talk about earnings as well. The ISM manufacturing number coming out a little bit later this morning. In about 25 minutes' time, Guy Johnson and Alex Steele will go through that for you. We'll get a PMI from S&P Global as well for manufacturing in America in around about 10 minutes or so. Then on to tomorrow, JOLTS. After that, you'll get more claims data on Thursday in between the ISM Services Index and onto payrolls on Friday too. Looking for 250K on payrolls, down from 372. The story so far, a dovish interpretation of Chairman Powell on Wednesday, expecting some pushback to that in the coming weeks, I'm sure, from Fed speakers, reinforced by a downside surprise on GDP. That sparked another upside move, another leg higher after a monster rally through most of July already. All of this stoking questions over whether it can continue.
In terms of equity markets,
they've rallied considerably in July.
You have also had an okay earnings season.
The Fed that just sort of stayed on script.
Seemingly quite a dovish tone and rhetoric.
Didn't, provide an additional negative catalyst into the market.
It probably is a bear market rally.
Expectations just got, so extremely low that it didn't take a whole lot to kind of surprise.
Thinking about what does the equity market look like from here?
We'd like to see some follow through.
We're going to need to see more reassurance that interest rates aren't going to come back.
We still are coming off of quite high readings on inflation.
Until the Fed seems comfortable that inflation's under control.
This doesn't feel like a stable equilibrium to me.
I don't think I'd call it a bull market.
More in the kind of bear market rally, less in the, durable rally camp.
This is a bear market rally.
Joining us now is JP Morgan's David Leibovitz. David, I'm going to ask you now, is it or isn't it a bear market rally, and how on earth do you know?
So I think it's a bear market rally, and I think, a lot of the points that have been made over the past couple of weeks have covered this, but any time that the market is viewing bad news as being good news, I always become a little bit skeptical, because then you have to ask yourself, is there another shoe to drop, right? Will there be a bad piece of information that the market just decides is too negative, and that can certainly get things moving in the opposite direction. I also think that the market has misread what Powell was saying last week, particularly during the press conference. And, you have these expectations that the Fed is going to begin to cut rates in 2023. I think that is a bit of a stretch. I think if nothing else, we expect the Fed to decrease the magnitude of its rate hikes over the course of the next couple of meetings. But the bar for a rate cut feels particularly high, and I think that the market may have gotten that wrong. So I'm going to go with bear market rally here. But we are more constructive today than we were at the start of the year. So for long-term investors, we think that the entry point is becoming more attractive.
So David, square that one for me, because some people look at this rally and say it's self-defeating, it's an easing of financial conditions, it's premature, this Fed needs to push back. At the same time, you're becoming more constructive in certain pockets of this market. So tell me where you're more constructive and why Fed pushback won't destroy that story.
So I think the first thing to keep in mind is that, we're skeptical about how far the Fed is going to get. We do see them continuing to hike rates through the end of this year, but then very much believe that they will go on pause. Nonetheless, against the backdrop of elevated uncertainty and policy rates that are moving higher, we need to focus on the earnings. And so that really means two things for us. On the one hand, we like companies with operating leverage. We like the industrials. We like the materials. We think that there's probably some juice left in the energy names as well. But at the same time, when we look at what's gone on with the large cap growth names, we recognize that valuations have re-rated significantly. And so I guess one way you could put it, John, is that we're owning value for the growth and we're owning growth for the value in this environment.
You're going to confuse me. It's still too early in the week, David. I think I caught up with that just about. Savita Subramanian published from Bank of America. She wrote this just moments ago. Was June and the June low the big low? Our bull market signposts say no. She's gone on to say prior bear markets also ended after EPS cuts. We're still in the very early innings of a downturn and estimate cuts. David, you mentioned earnings and how important they are. We're all on the same page. Where are you looking for these cuts to come through? If not energy, and if you like tech just a little bit more relative to where you were, where do you think they're going to be?
So I think that, the question is more about the magnitude of the cuts more than it's about, will there be cuts in and of themselves. I mean, it wouldn't be surprising to see earnings downgraded, particularly for 2023, where consensus estimates are just too high. I frankly think that they'll come down effectively across the board. But, the question again is how much do they re-rate? And I think that some of the steps that companies are taking today in terms of reducing their expense bill, obviously some certain sectors have had the ability to pass along higher costs in the form of higher prices, and that's helped defend margins as well. This is increasingly becoming a sector by sector and an industry by industry story. And as a result, I do think you'll see that wholesale downgrade, albeit for slightly different reasons.
Equity's getting hit right now, about 9 or 10 minutes in. We're down 0.6 on the S&P. On the Nasdaq, we're down 0.4. The small cap suffering, the Russell down by 1.3%. David, in a moment, you and I will talk about the data. We'll get a PMI final read for July in about 4 or 5 minutes. We'll break that down with Mike McKee, and I'll come to you. Before we get there, can you just walk me through how you expect the bond side of a portfolio to perform in the environment you're anticipating if things do get a little more trickier for this equity market in the weeks and months ahead?
So I think that everybody has a bad taste in their mouth, given what went on at the beginning of this year when we saw stock-bond correlations turn positive. At that time, inflation was very much in the driver's seat. The Fed was very much in the driver's seat. People weren't worried about a negative shock to growth. And so, by my lights, now that the questions are more around the growth side of the equation in the current environment, that slower growth could be what allows bonds to actually help investors play defense, if things continue to look like they're getting softer.
Savita, as I said, from Bank of America, said we might not have seen the low in this equity market. Do you think we might have seen the high on a 10-year yield, David?
I think that we have seen the high on the 10-year yield, and I think if nothing else, what the equity market will require in order to behave a bit better is stabilization on the interest rate front. Interest rate volatility is still entirely too high for equities to find their footing, and so I do think we need to take a cue from rates when thinking about the broader story around risk assets.
The curve a bit flatter this morning. The 2-year up a basis point, the 10-year down a basis point. David, you're going to stick with us, I'm pleased to say, to break down some of that economic data with Mike McKee and talk about this U.S. economy in about 4 or 5 minutes. So yields come in a couple of basis points on a 10-year, 263. In the equity market, about 11 minutes into this, we are lower by 0.5% on the S&P. On the Nasdaq, we're down about 4 or 0.5%. Coming up, investors look into a host of fresh data for signs of a potential recession.
It's going to be important what we see in the labor market. It's going to be important what we end up seeing in the PMI numbers between now and September.
Ton of economic data coming up this week and a ton of Fed speak expected as well. That conversation just ahead.
Jeff Bezos realized you could sell anything on the internet.
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become
the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who are making things as important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it. And I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
It's going to be important what we see in the labor market. It's going to be important what we end up seeing in the PMI numbers between now and September. Ultimately, in order to get the market to start moving higher in yield again, you're really going to need to see growth data rebound.
Not seeing that right now. Just getting some data from S&P Global. Let's get to it. Here's Mike McKee.
Well, John, we get the S&P Global U.S. Manufacturing PMI, and it's not all that bad. It's still expanding. 52.2 is the number for the month of July. The final read there, it was 52.3 last month. So it is not showing signs of collapse in U.S. manufacturing, unlike we're seeing elsewhere in the world. You take a look at what's happened. We got PMIs from everywhere from the weekend into today, and they basically show manufacturing has just stalled out. The Chinese are showing contraction. Germany, France, Italy, and the Eurozone all falling. The surprise is your UK, John. All we hear and see is headlines about how miserable everything is, but they're still expanding at 51.1.
Just miserable people, Mike. That's the problem.
Well, go Lionesses. They won yesterday. All right, the big number of the day is going to be the ISM PMI here in the United States. And one thing is we're seeing, we have a different kind of manufacturing here than a different kind of problem here. We don't have the supply chain problems that China and Europe are having right now. And that is expected to come in at 52, down from 53, but still showing expansion. That's at the top of the hour.
What do you make of ISM services later this week, Mike, given what we saw in the PMI in the last couple of weeks?
Well, that's going to be interesting because we did see drops in PMIs in Europe, and we've seen it in China as well, although they're still positive. So the question is, did people cut back on spending, or did they do more spending? We thought they would do more in the service area, but the GDP and spending numbers showed for July, they didn't. They still bought more goods. So it'll be an interesting number to look at.
Mike, final word just on payrolls coming up Friday. You and I will have plenty of opportunities to talk about this, but what you're looking for going into this week?
Well, you're looking for a slowdown. That's what the Fed's been looking for, but we get jolts on Wednesday, and that'll show us if we've started losing some of those open jobs. And we're not expecting any change in unemployment, according to the economists we've surveyed. So at this point, it's kind of status quo in the labor market, which Jay Powell says gives them room to keep cutting.
Do we see some heat come out of this labor market, and does that jolts data capture that? with some reduced job openings. Mike, thank you. We're about 17 minutes into this. We're down 0.4% on the S&P. On the Nasdaq, we're down about a third. We recovered just a little bit, as Mike McKee pointed out. I know Mike very well. I'll pronounce his name properly. Mike McKee pointed out in about 13 minutes, you'll get the ISM data on the manufacturing side in just a moment. JP Morgan's David Leibovitz wrote this: the economy is losing momentum. However, the Fed will continue to tighten, but it is not clear that the Fed can reduce labor demand job openings without pushing the unemployment rate higher. David's back with us for more. David, your thoughts on the data and just on that conclusion. If we're going to push the unemployment rate higher, does that mean we ultimately have to push this economy into a recession?
So I think that there are two things there. I think one, the PMIs obviously give us a very good look at data more in real time. And, you know, rather than debating 52 versus 53, I think what'll be interesting to look at the trends that are emerging across manufacturing relative to services, because a thesis that a lot of people have had up until this point is that the manufacturing numbers should begin to get a bit softer, but the services numbers are going to hang in there. Regardless, the question is about the labor market. And I think what is so challenging in the current environment is that, you know, labor is the one thing that people continue to cite as keeping us out of recession. In order to deal with the inflation problem, it does feel like we need to have a recession. If you look back at the data to 1960, mid-cycle slowdowns do one thing. They prevent inflation from continuing to rise. They do not get inflation to fall. And so it does feel like a recession, albeit a mild recession, is becoming a foregone conclusion if we're going to put this inflation genie back into the bottle. The silver lining here is that when we look at the most cyclical parts of the economy, things like housing, business investment, inventories, and autos, nothing looks terribly offsides. And that does reinforce our conviction that any downturn in the economy would be relatively manageable and hopefully get inflation to a spot that makes investors and the Fed feel a bit more comfortable.
David, what do you think the biggest risk around that view is right now? Because you and I can both appreciate that's quickly become the consensus view, that if it's recession, and many people think it already is, it's short, it's shallow. What do you think the biggest risk around that view is?
So, you know, we've spent a lot of time thinking about that, and I've heard various other folks kind of espouse their theories. I think that the big risk there is that, you know, we end up seeing some sort of liquidity or balance sheet issue. I think one of the big distinctions of the current environment relative to what we saw in the run-up to 2008 and relative to what we saw during 2020 was that we see the potential for a balance sheet recession as being limited. But there's been massive wealth destruction so far this year. People are hanging on because incomes are growing and they do have accumulated savings, albeit they're not interested in seemingly spending those accumulated savings. I think that a balance sheet recession, something that really squeezes the consumer like we've seen over the past two downturns, is the biggest downside risk to our base case view.
Just quickly then, one final question from me, David, and I'll let you run, and thanks for all your time this morning. It's really important to us. Just a final question. Do you expect the weakness that we're starting to see evolve spill over into the labor market this quarter, or is that too soon?
So I think that you are going to see the labor market numbers begin to soften. I've always been a big fan of jobless claims because it comes out every week, and the claims data has been steadily marching higher over the past couple of weeks. And so I think that, in concert with what you're hearing from corporations during earnings season around expense management, leads me to believe that the labor market numbers are going to begin to get a bit softer here over the course of the coming months.
David, thank you, buddy. As always, good to catch up. David Leibovitz there of JP Morgan Asset Management. About 21 minutes into this, we're down a third of 1%, recovering slowly on the S&P. On the Nasdaq 100, we're lower on the Nasdaq. We're down about 0.2%. Abby, we've got to catch up about that Apple story. They are very, very good at timing this debt market.
They certainly are, John. And it's interesting because you were just mentioning futures off the lows. That has a lot to do with Apple, because after announcing that four-part bond deal, that 40-year deal, about 140 bips above, 150 basis points over Treasuries, Apple had been down about 1%. That had really dragged on the markets. Moments ago, up 0.3%, up slightly right now. But to your point about timing it really well, of course, in the back half of July, we saw this big rebound in credit as investors and traders became more optimistic. So Apple taking advantage of that to fund corporate uses, mainly dividends and buybacks, according to one source. But they have no shortage of cash, John, as you know, about $180 billion. And historically, because this is actually the fifth bond offering over the last roughly 5 years, on the day of the announcement, the stock closes up more than 1%. So today's reversal, no surprise. And if it goes up more than 1%, that would be right in line with the history of Apple.
Abby, thank you. Larry McDonald over at the Bear Traps Report sent me a chart months ago of Luca Maestri, the CFO of Apple, just plotting where he issues debt in the credit market and the timing of it, and then what happens with credit spreads after they widen, interest rates start to climb. Just a fantastic timer of this credit market, it seems, and I know a lot of people are talking about that this morning, going into potentially a busier August relative to what we've seen so far this year, so far this summer on the supply side. Just one thing to watch. Here's another, of course, Speaker Pelosi and her trip to Asia. Will she or won't she land in Taiwan? That is a huge, huge focus of this market now, going into tomorrow off the back of recent reports suggesting she could be landing there tomorrow night, local time. We'll build on that story through the day on Bloomberg TV and on Bloomberg Radio. Coming up, I'll get you the trading diary, the expected scheduled events of the week ahead, and there are many from New York. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Coming off the back of the biggest month of gains on the S&P 500 since November 2020, about 25 minutes into the month of August, we are lower by about 0.1%. No drama here, just a bit softer, lower, negative, lighter on the S&P. Add a little bit more weight to the Nasdaq 100, up about 1/3% or so. That's the price action. Here's your trading diary. At the top of the hour, ISM manufacturing numbers coming out. Speaker Pelosi continues her tour of Asia in Singapore. Plus tomorrow, Fed speak from Evans, Bullard and Mester on Tuesday, along with the US JOLTS report. A Bank of England rate decision and initial jobless claims coming up on Thursday. Some talk of 50 basis points on Threadneedle Street later this week from Governor Bailey and the Bank of England. And finally, we round down the week with the main event on Friday. It's the US payrolls report, and I can tell you a ton of data in between. We're looking for 250K on Friday. The range, the high 320, the low is 50. From New York, this was the countdown to the open. This is Bloomberg.
now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
Federal Reserve, of course, raising interest rates by 75 basis points again.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind. but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gauridoddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat, because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.